Alrighty, moving on to day 10 of the 30-day Trader's Induction here on the YouTube channel. We're going to be diving into paper trading and broker selection. So this is where we're going to start getting a little bit hands-on with how you can actually interact with the markets and start placing some orders and executions. So firstly, what's a broker for? A broker is a platform that facilitates the buying and selling of trading instruments. So in short, they're the middleman between yourself and the exchange. It's not really possible for the normal retail people to go and directly execute on an exchange. So what we need to do is we need to pass our money over to a brokerage account or a broker who will then execute the trades for us directly into the liquidity pools and to the exchanges themselves. So selecting the right broker is vital to a trader because it can, in some extreme cases, make or break somebody's capital. They can make or break their trading experience in terms of maybe the volatility or the broker playing games, raising spreads and tagging things out when maybe it shouldn't be the case. So it's very critical to do the research and understand where you're putting your money and how regulated and how secure it is. So some considerations when selecting a broker. Number one, regulation and security. So we want to be looking for the main big players, like the Barclays and the HSBCs of brokers in the industry. You can get the really small brokers which are not very regulated and they're much more prone to security risks and hacks, for example, and also just some general misbehavior on the broker's side with regards to your money and the execution. So looking for the regulated brokers is going to be key, and generally you can do that by sticking with the larger players. Fees and commissions is another one as well. If you're trading with one broker but someone else does it cheaper, then maybe it might be in your best interest to at least examine whether or not it would be wise to take the shift over to somewhere else. Maybe the fees you're paying and the commissions you're paying on your trades is extortionate and just not justified, and you're just maybe with a lower quality broker that is making all of their money from the executions and the commissions rather than their normal business models. So a little less of a concern. The fees and the commissions are pretty standard across the board, but just something to be aware of when selecting it. You don't want to be shafted when you go place your first trade because you didn't do your research. Next up are the platform features. So some of the brokers don't have any platforms that you can execute on. They integrate into an existing third-party platform like MetaTrader or CTrader, for example. Whereas some bigger players, they do have their own trading panels and platforms, which are quite cool. Platform features as well. Maybe they have the inbuilt charts, they have the trend line tools and the different technical tools that you can use. It just comes down to personal preference on do they have all the features and the things that you want. Maybe you want the scanners and all that kind of stuff. So just making sure what you're signing up for in terms of the broker, they have all the features that you want. Maybe the same day payouts or instant deposits and things of that nature. So instrument availability, this is probably the most important one to be aware of, because what's the point of signing up for a broker to trade an instrument that you want to trade but they don't host it? So some of them host a larger variety of instruments, which are good. They have their benefits and drawbacks to doing so, but you want to make sure that you're with a broker that actually hosts and has available for you to trade the instruments that you're analyzing on the charts. And next up is customer support. So you may not need it very often, but when you do need it, it's one that you want to be able to rely on. If there's some fuckery going on with your balance or executing of positions, you want to be able to call these people and ask what's going on with my money, what's going on with this position. You want someone that will be there to support you with your capital. So moving on now away from the brokers, we're going over into the principle of paper trading. So what is paper trading? Paper trading is a risk-free way to practice trading using virtual money in real-time market conditions. So there's a few benefits and a few drawbacks to them, and we're going to go cover some of these now. Firstly, just to touch on what the paper trading is a little bit more, these are basically demo accounts which can simulate a sandbox environment where you're able to execute the positions in the markets on a trading platform and manage them and close them and see the profit and loss and everything to do with the trading experience except for the withdrawing of the money into the bank account, unfortunately. So it's just a sandbox demo mode that you can go in and play with. So one of the first benefits is that you can practice strategies without risking real money. Either you are looking for a new strategy that you want to trade, maybe instead of going back over the old data, you want to start putting some trades on the line to see if it's profitable. You want to see how the executions do play out. You can open up a demo account, start executing some positions and taking some data that way, maybe on a forward testing basis, and with no downside risk financially with regards to actually executing the positions. Another benefit is to gain familiarity with the trading platform. So, for example, you open up a new broker that you're not really sure with. You don't really know how the contract sizing and all of all the buttons work. So just whip open a demo account with them before depositing your funds, and you can go and execute a few positions, see if it's something you want to work with, and then you can get your clarity that way. Another one is that you can learn how markets function in real time. So, like I was saying, it's a real-time experience in a sandbox mode where you can go in, place a position, size it up, stop loss target, getting in, getting out, managing positions. You can do everything in the experience of trading from executing to closing without having real money on the line. So it's very good, especially for the newer traders, to gain familiarity with that process of actually looking at a position, sizing it up, executing it, getting in, getting out, and logging the data and understanding what that process looks like in a completely risk-free environment. Now, how to set up a paper trading account. There's 3 primary ways that I'm going to share with you now, which are the ways that I would do so. And I'm sure there's probably more, but I can't really think of them. You don't need anything more complicated than any of these 3. Number 1 is TradingView, which is the charting software that I've recommended everybody use. They have their own built-in paper trading broker down in their brokers panel at the bottom of the screen. Just press the trading panel button and then open up paper trading here, and you can select how much cash you want in the account. You can execute directly within the TradingView platform and go from there. So I won't show you exactly how to execute the positions. That might be a video for down the line, but this is exactly where the TradingView built-in paper trading platform is within the application. So this one's very good. It saves you having to go somewhere else to execute the positions and practice that way. Number 2, is the FTMO free challenge. So FTMO is one of the largest funded account programs out there. That you can pay the challenge fees and go through the challenge accounts to withdraw full money. But what you can also do is take the free trial of the evaluation accounts. So they're perfect examples of exactly the process that you would go through to take on a funded account, or maybe open a broker with someone and pull these details and put them into a third-party platform like MetaTrader to execute on. So you get the credentials for the account, you plug them into MetaTrader 5 or MetaTrader 4, and then start executing on the positions that way. So FTMO free challenge, just Google it, ftmo.com, and then you can start the free challenge. They'll send you the creds, log into MetaTrader, and you can start executing that way. And then another one is through your broker directly. So on many of the larger brokers, you have the ability to open a demo account, especially in the early stages of opening the account with the broker. Do a demo account, just see what's going on, see if you're comfortable with all of the platform and how it all works, and start executing the demo trades through there, get a feel for it, and then move on. So I recommend the FTMO free challenge as the most ideal situation. TradingView built-in is good, but it's less of a real-world use because for security reasons, maybe it's not the best idea to connect the broker into the TradingView platform. So I personally don't use the TradingView built-in to execute positions. I do it in the same way that FTMO uses it through MetaTrader or directly on the broker. So these bottom 2 are probably your best bet, but there's no problem using the TradingView built-in if that's more your style. So now we're going to have a quick conversation on my thoughts on paper trading. It's a very controversial topic. There's benefits and drawbacks to doing it and not doing it. Everyone has their own opinion. This is just mine. And we're going to start off with some of the benefits. So number 1 is it's a risk-free environment. Like I was saying, you have no downside risk in the ability to learn how to execute positions and see them through from open to closure, and just get comfortable with the idea of actually getting in the markets and getting out. It's good when learning how to execute. Maybe you don't know how to size a position properly, so this will give you a nice way to find your own approach on what works for you to execute a position with regards to risk management, etc. Now, I think I've covered the benefits a fair bit in this video, and now it's time to talk about some downsides. So first up, it's not real. It's not real. That's it. There's no emotions into it. There's no skin in the game. It's just numbers on a screen that mean absolutely nothing to you. So there's a lot of people, especially on Twitter, that are going around, posting all these crazy wins and profit and loss statements. But if it's on a demo account, everyone's a professional trader on a demo account, and it's just not real. It's not real. There's no emotions. There's no learning experience. There's no real world application. It's just like Monopoly money. It's the same as being rich in Monopoly, trying to use that in the world. It's not real. It's not real. So with that being said, I think that links very good back into the benefits section, is that it's really good to learn how to execute and use, but the key critical factor is to be careful not to get hooked on it. You want to get in, you want to learn how to execute, you want to size up some positions, see what the process is, see whether it works best for you in TradingView, on your broker directly, or on a third-party platform like MetaTrader. Learn how to execute and get off and put some money into an account. Start small and scale up. You don't want to get hooked on it, because you'll start getting in the trap of, okay, let me just gain some more experience. I need a little bit more experience. I need a little bit more experience. So I need some more data. I need some more data. I need some more data, some better results, and then I'll start looking to go full time. It's a trap that will keep you hooked in the simulated, not real world. The profits are an illusion. It's not real. Don't get hooked on it. It's not real. I can't stress that enough. Get off of demo as quickly as you can once you have learned just the technicals of executing a position, seeing it through, and getting out. Next up is calling a market is not trading it. So even if you do place a trade on a demo account and it does go into the win, you've not traded it. You've not made money from it. You've just analyzed and called the market, if you will. It's one thing to be able to call a market that it's going to go from price point A to price point B, and a completely different ball game to actually executing at price point A and getting out at price point B. It's a big difference between analysts and traders, and calling markets and not trading it. And I specify calling a market and demo trading as the same thing. So paper trading is not something that we want to sustain longer term. We purely want it to get in to a position, to get out of a position, understand what that process looks in the very, very, very early stages. Then we're going to look to fund a very small account in a reputable broker, and we're going to look to scale up that way. So some additional tips: start with a demo account, get in, get out, end of story. Read up on the reviews, so go find some of the big players. To name a few, there's FXCM, IC Markets, Oanda for the normal brokers. Saxo Markets is another one. You've also got IG Index. These are some of the larger players out there. And then in the funded space, I'm looking at things like FTMO, and that's really the only one I'm going to say the name of, because I don't know or trust any others. Maybe not so much trust, but not trust because I don't know much about them. I only use FTMO. So FTMO is a funded platform. MetaTrader 5, you want to use the latest platform to execute through. I think CTrader. I've never used CTrader, but that's similar to MetaTrader as well. And read up on the reviews of all of them. Read up on the reviews, the pros, the cons, the comparisons, what works for you personally, and then get in and get trying on the demo accounts. And then if it's okay, you can start small with a small amount of cash. Stick to the bigger regulated ones. Again, you don't want to be using these small little prop firms or these small little brokers that have just started out last week, that only have a couple of followers on Twitter or a couple of reviews online. You want to stick to the regulated ones that have got the proper regulation with the financial authorities wherever you are in the world. Start small and partition the capital. So this is just something I learned a little while ago that I think is really important and a very, very smart idea, especially when it comes to the earlier stages, maybe in a new broker or even in the trading journey. So number one, start small, partition the capital from a security perspective, is that you only want to put a little bit of the cash into the account and then build it up that way. but also by extension to that is you want to partition capital with regards to how much is being left in the broker. So say for example you've got a £100,000 trading portfolio. Instead of putting all 100,000 into the broker, what you can do is you can put 50,000 in a savings account and 50,000 in a brokerage account and risk 2% on the broker, so that you're meeting the risk parameters of the 100,000 trading portfolio, but from a security standpoint, you've only got 50k in the brokerage account, which if anything were to happen to the broker, you don't lose 100%, you only lose the 50% if anything were to ever happen. So it's just about hedging that risk in that way. So partitioning the capital is another way just to increase a little bit of security. So in summary, we've covered what a broker is and what they're used for, considerations when selecting a broker. We've gone over what paper trading is, which is the demo environment, and as well as how to set one up using the trading view, using the third-party FTMO ones, or through the broker directly. And we've also covered my thoughts on paper trading. So I think I've summed that up quite nicely, and some additional tips as well. Which is what we just covered. So moving on to day 11, we're going to go cover some of the pips, points, and ticks, and that's going to be dissecting what the numbers on the y-axis of a price chart are and how they vary through different markets. This is going to be quite important and one of my favorite topics to dissect and dive into, because it can be an area of confusion if you're navigating markets that maybe you're not so familiar with. So hope you enjoyed the video. Thank you very much for watching, and I shall see you tomorrow.